Whether you're a new or seasoned business owner, one of the most important things that you need to understand is how to get paid in your business. And if you're like me, you got into business for one specific reason, and that is to get paid, okay? And that's exactly what I'm gonna share with you right here in this video. All right, so let's talk about the art of paying yourself as a single member LLC and uncover the money-making benefits of transitioning over to a different type of business structure. I promise you, if you stick around, you're going to be blown away by how you can go ahead and do this and literally save hundreds of thousands of dollars in taxes. All right, but before I get into that, let's talk about probably one of the most misunderstood concepts, even by your CPA, even by your EA, as it relates to your business structure. And if you don't know this can literally cost you and your business a fortune. All right, so make sure you pay close attention and write this down. Okay, as it relates to your business structures, you have different types of business structures. Okay, you have what are called legal entities and you have what are called tax entities, and this is going to impact you as it relates to making sure your business is protected, also how you're going to be taxed as it relates to the type of income that you're going ahead and paying yourself. Okay, and as the name suggests, a legal entity is designed and there for you to protect you for legal reasons. Okay, so there are different types of legal entities that are out there. The main ones that I want you to focus on and know about is what's called a sole proprietorship. You also have what's called a LLC, a limited liability company. We're going to talk a lot about that. There's also what is called a partnership, and then last but not least, a corporation. Okay, and these are going to be the four types of legal entities that you need to be aware of. As it relates to tax entities, there are different types of tax entities that you need to be aware of as well. So tax entities, this is going to be actually how you're taxed, and this is recognized at the federal level. You have what's called a sole proprietorship, you have a partnership, an S corporation, and you also have a C corporation as well. Okay, and again, this is going to impact how you're taxed. So one of the reasons why an LLC is considered disregarded for tax purposes is because the IRS does not recognize them, because it's only recognized at the state level. And again, it's designed for legal protection. What do I mean by legal protection? So in the event, let's say for instance you have real estate, and let's say for instance you have a tenant that slips and falls, one of the things that the legal entity can do for you is it can protect you and protect your personal assets. What do I mean by your personal assets? Your personal assets are going to be things such as your bank account, your house, your car. These things are considered your personal assets, and now by having a separation between you and the business, they can't necessarily go after your personal assets. So hopefully that makes sense. And why this is so critical and why this is so important for you is because by having this different entity, you are now a separate person. So one of the things I suggest all business owners make sure they get is what's called an EIN number. Okay, an employer identification number. This employer identification number is going to be like a social security for your business, and more importantly, it's going to allow you to have a whole bunch of benefits like opening up a business bank account, getting access to business credit, and much more. So I want to recommend you go ahead and do that to also give you privacy as well. So one of the things that's going to happen is when you go ahead and get your LLC registered, it's not going to be public information. So by having that information public now, when you go ahead and fill out business documents, you want to make sure there's some separation between you and the business, and by having that EIN, now it creates a social security number for your business. So that's going to be super key for you, along with a ton of other benefits as well. Now, going into these different tax entities. So we have these tax entities, and it's going to impact how you're going to be paid. So by default, when you go ahead and jump in, you're automatically going to be sole proprietorship, and you have to pay what's called self-employment tax. Okay, so you have the legal entity and tax entity. By default, you have what is called the self-employment tax. We're going to talk about self-employment tax, how to be able to avoid it legally and ethically. But before we get into that, I also want to share this really important note as well. And it's going to impact how you're going to be taxed and how you're going to pay yourself through your business. So you have the sole proprietorship, and it's going to determine how much you're going to be taxed on the money that you go ahead and bring into the business. So let's say you're just starting off in business, okay, and you have this sole proprietorship. That business makes $75,000 in profit. So you have a $75,000 in profit with that business. And let's say you're now unfortunately required to pay that 15.3%. Why is it 15.3%? So the 15.3% is actually there because it's like you paying yourself as an employee and as an employer. So if you think back, if you're working a 9 to 5 right now, or if you could think back when you worked a 9 to 5, or if you never worked a 9 to 5, you probably already understand the concept of payroll tax, okay? And with payroll tax, your employer pays 7.65%, you as the employee pay 7.65%, combined that is 15.3%. So now by having this business, just by being a sole proprietorship, you have to pay what's called self-employment tax, and you have to basically pay that 15.3%, okay? So let's say, again, you have that $75,000 in your business as profit, you pay that 15.3%, now you're paying over $11,000 in taxes, okay? So that could be a lot of tax for you depending on how much money your business is making. So one of the things that you want to consider doing is switching over to a different tax entity. But again, you want to focus on making sure you have the right legal entity in place before you go ahead and do this as well. So like I said, the LLC is going to provide that legal protection for you. A corporation is also designed to give you that legal protection. Unfortunately, on the legal entity side, a sole proprietorship and a partnership is not going to give you that legal protection, okay? So you want to make sure you either get an LLC, limited liability company, or a corporation as well. Now, on the corporation side of things, or on the tax side of things, what you can do is switch over to what is called an S corporation, okay? So this is like the holy grail as it relates to tax savings, and it's really going to make a huge difference as it relates to being able to pay yourself through your LLC. So you can pay yourself as basically be taxed as an S corporation. What that's going to do is, instead of paying that 15.3% on the profit that you end up having in your business, now that 15.3% is going to now be impacted by the salary that you pay yourself. So one of the requirements in order to have a S corporation or be taxed as an S corporation, it is what's called a reasonable compensation. You have to pay yourself a salary, okay? As just a sole proprietorship, you're not necessarily required to pay yourself a salary. The money that's coming out of your sole proprietorship, that is going to either be considered owner's draw, so you don't necessarily get paid. You don't pay taxes on what you pull in and put into the business as a sole proprietorship. Granted, you now have to just pay that 15.3% on the profit of that. So that's going to be really key. So now going over to this S corporation, like I said, this S corporation is literally going to save you hundreds of thousands of dollars over your lifetime if you go ahead and do this the right way. So one of the things I recommend is you want to go ahead and switch over and considering switching over to an S corporation if your business is making more than $40,000 in profit. And the reason why I say $40,000 is because if your business makes less than that, basically the cost benefit of doing that, it's not going to be really beneficial for you. Now you have to put yourself on payroll, you have to pay all these different fees, it's more expensive to get your tax return done, so it's not really beneficial for you to switch over to it. But once you go ahead and make more than $40,000 in your business, or if you know you're on track to make more than $40,000 in your business, you want to fill out a form called 2553. So 2553, that is the form that you're going to want to fill out. And according to the IRS, you want to make sure you fill that out within the first 75 days of the year, okay? And this is going to be really key because, again, if you don't do that within the first 75 days of the year, you're basically going to be considered late and you're going to miss that deadline, okay? Now, if you work with a tax strategist, a CPA, someone who's more familiar with the tax law, they could be able to help you still be able to do it after those 75 days, but you want to make sure you do it within those 75 days to make sure that you're compliant and you can avoid issues, okay? Cool. So now that you have that, now what you want to do is you want to go ahead and put yourself on payroll. One of the things is you can decide how you want to pay yourself during the year. You can pay yourself every 2 weeks, every week, once a month. You can even do it once a year just to make sure you're compliant with this thing, okay? So one of the things that you may be asking yourself is, okay, well, I know that the more I pay myself, the more taxes I have to pay, okay? Because this is the way the math works. So let's say you have that $75,000 in business profit. Let's say you pay yourself $37,500, which is half of that profit that you made in your business. Now you're paying about $6,000 in taxes, okay? So $6,000 in taxes, or about maybe less than $6,000 per year. So you're probably around $5,000 in taxes, okay? So the difference between that $11,000 and that $5,000 that you're paying is literally over $6,000, okay? So I literally just saved you $6,000 by just switching over to the right tax entity, okay? And that's why I kept honing and really spending a lot of time on that tax entity, because it's gonna be really key for you to understand. So let's say you're 10 years doing this in your business, okay? Let's say your business happens to stay at the same profit that is literally over $60,000 over a 10-year time period, okay? So that is a huge tax savings. Imagine what you can do with an additional $60,000, okay? Imagine what you do. Would you invest in the business? Would you spend that business on basically spending that money to be able to travel with your family? The sky's the limit, and that's why so many people, by not understanding this, they're overpaying in taxes, okay? And one of the best ways to not overpaying taxes by getting what's called a tax plan, okay? So again, you want to make sure that you're doing this the right way and you're working with a professional that understands this, because it's going to be a game changer for you, okay? So again, just to recap a couple of takeaways and things I want you to write down and remember as you go ahead and do this in your business, okay? So number one, having that LLC and paying yourself as a sole proprietorship through your LLC, you could do what's called an owner's distribution or owner's draw. You don't necessarily get taxed on that money that you're pulling in and out of the business, but just know that the profit of the business is going to be impacted by that 15.3%. That's going to cover things such as FICA and Medicare and all the different things. Again, it's going to be that 15.3%, which is how you're going to get taxed on that. By switching over to an S corporation, then you're able to now save on that self-employment tax. And let me give you a big one here as well, okay? You have a corporation. Now, corporations, they have a flat tax rate, okay? But one of the disadvantages of a corporation is now you have that double tax, okay? So you want to make sure that you work with a professional to go ahead and run some analysis for you to see what is going to be the best option for you as it relates to your tax entity. Do you need to be an S corporation? Do you need to be a C corporation? Okay, same thing with a partnership. You do have the ability to go ahead and be taxed in different ways. That's a conversation for another day, but in the meantime, you want to understand these important concepts because it's going to be a game changer for you and your business. All right, so again, if you like this, make sure you go ahead and like and subscribe. Make sure you go ahead and check out this next video as well. Oops, over here. All right, and I'll see you in the next one. Take care.